A home equity line of credit, HELOC, is a flexible financial tool that allows homeowners to leverage their home equity for various purposes, such as funding major expenses or consolidating high-interest debt. During the pandemic, mortgage rates reached historic lows. At the same time, home values shot up. This gave homeowners great opportunities to tap into their newly gained equity using cash-out refinance mortgages, which allowed them to take advantage of low mortgage rates while also using the cash in their home to achieve other financial goals. But so far in 2023, rates have been much higher. This means that getting a cash-out refinance doesn't make much sense right now, because most homeowners have locked-in rates that are well below what they would get by refinancing. To access the equity they have in their homes, many homeowners have turned to HELOCs, which don't require them to replace their mortgage and take on a higher rate. Individuals can borrow money as needed, based on the value of their home that they own outright. Calculating home equity involves subtracting the outstanding mortgage balance from the current value of the home. For example, if your home is valued at $400,000 and you owe $300,000 on your mortgage, your equity would be $100,000. While a HELOC can be an advantageous way to tap into home equity, it is important to note that it is not without risks. Since the home serves as collateral for the line of credit, falling behind on payments can potentially lead to foreclosure by the lender. Thus, it is crucial to have a thorough understanding of how HELOCs work and carefully consider the pros and cons before deciding whether it is the right option for your financial needs. While both allow you to access your home equity, they operate differently. With a HELOC, you can borrow funds as needed during a draw period, followed by a variable interest repayment period. In contrast, a home equity loan provides an upfront lump sum that requires immediate repayment, usually at a fixed interest rate. A HELOC enables homeowners to borrow against their home equity, up to the approved credit limit, using their property as collateral. During the draw period, which typically lasts between 5 to 10 years, you can access the funds through credit cards, checks, online transfers, or in-person cash withdrawals from local branches. The minimum payments during this period generally consist of interest-only payments or a combination of principal and interest. As you gradually repay the balance, the available credit is replenished, allowing you to borrow, repay, and reuse the funds multiple times during the draw period. This functionality is similar to that of a credit card, where you have a spending limit and can continually charge and repay the balance. When the draw period concludes, you enter a repayment period that typically spans 10 to 20 years. During this phase, you are no longer able to withdraw additional funds, and the focus shifts towards paying off the principal and interest. It is important to note that HELOCs often involve variable interest rates, meaning your monthly payments can fluctuate periodically in response to market interest rate changes. However, many HELOCs feature caps, both periodic and lifetime, that limit the extent to which interest rates can increase annually and over the duration of the loan. The IRS allows for the deduction of interest paid on equity loans or HELOCs up to $750,000, $375,000 if married and filing separately, provided the borrowed funds are used for purchasing, building, or substantially improving the home securing the loan. To claim this deduction, you must itemize your tax return. Overall, HELOCs provide homeowners with a flexible means of accessing their home equity. By understanding the workings of a HELOC, homeowners can make informed decisions regarding their financial needs and obligations.